Most of you in here realize that back in 2009, we were given this book, Becoming Your Own Banker by Nelson Nash. And after reading this book in the summer of 2009, that inspired me to read probably another 200 plus books about the actions of Wall Street, the banks, the government, etc. And considering the fact that I've been doing this 34 years and sat in over 20,000 individual meetings with individuals' families, it caused us to then understand the need to write a book which is called The Control Option. And the purpose of The Control Option is to help people understand that all of us have the option to control more of our wealth and more of our cash flow. And so we have literally been on an educational crusade since that time where we're trying to help people think differently. And if you can see the quote back over my left shoulder, we had started telling people or asking people if they would consider thinking differently. And I saw this quote in a strategic coach class in Toronto several years ago by Buckminster Fuller. And it says, if we want to teach people a new way of thinking, don't bother trying to teach them. Instead, give them a tool, the use of which will lead to new ways of thinking. So that quote basically led to us creating thinking exercises. It also led to us creating what I would call a unique role in the financial services industry, and that is one of a control option strategist. And so that's what I've been doing for the last several years, and we've actually built a learning institute for control option strategists, and then that's led to a unique process that we now do with clients, and that is where we help them discover their financial picture, and we do that with a series of thinking exercises. Once they complete a financial discovery, we then strategize with our integrated financial network, and then with our unique ability teamwork, we're able to measure and monitor the client, the individual, the family's progress for the rest of their life and for future generations if they so desire. Well, one of the basic thinking exercises that we do, we call efficiency of money thinking exercise. And that's what I want to go through right now. And I'd like for each of you in the room, and for the people who are going to be viewing this video, there's 7 people in the financial service industry sitting in this room, and we're just going to go through the efficiency of money thinking exercise. So I'm asking everyone in the room to take a notepad similar to the yellow notepad that I have up here in front of me. And it's like, this is the chalkboard in math class. And I've got students in the room, and I'm simply going to ask them to help me go through this thinking exercise. So there's going to be 4 parts to it. There's 4 concepts, and we're going to go through them one at a time. And so if everybody in the room would take this first concept, and I want to talk about an example of a bank loan that people have. So let's just say someone has a $24,000 auto loan. So if you will, just write $24,000 auto. And let's say that loan is at 0%. And then let's say that loan is amortized over 4 years. Well, of course, 4 years would be 48 months, and which is twice 24,000. So that monthly payment would be $500 a month. Now, in visiting with people over the past several years, as interest rates have gotten really low, there's a lot of people that will tell us, well, we don't really worry about this loan because it doesn't cost us anything, because it's at 0%. But then if we think a little bit deeper, we say, okay, that may be true, or it seems to be true, but if that $500 a month was able to be saved in an account somewhere, as opposed to having to send the $500 a month to the bank, if that money could be saved in an account, and let's just say that account generated $1,000. And in a concept that we work with a lot of people called privatized banking, if that $500 is deposited into what we call a banking policy, for the individual to receive a $1,000 dividend is not a bit unusual. So then we ask the question, if a person didn't have to send that $500 to the bank, and rather it was saved in an account that generated $1,000 of profit, then isn't it fair to say that having to send the payment to the bank is causing the loss of an opportunity? Okay, so if you would, just write opportunity loss, and that's the key takeaway from this point that we're making. Now, I was explaining this to a particular couple some time ago, and the husband, who's an engineer, said, well, Mark, I get what you're saying, but if my wife goes to the grocery store during this month and she spends $500 in the grocery store, isn't that also an opportunity loss? And to be honest, I hadn't really thought about it in that way. I hadn't thought that deeply, I guess. But when he asked that question, I was thinking, yeah, that really is true. And in fact, every dollar that we earn that we don't save, when we go spend it without saving it, we're losing the opportunity to get a return on those dollars. Those dollars are gone forever. Kind of makes sense? So the takeaway on this first of 4 points is that we have an opportunity loss, potential opportunity loss, on all of the income that we earn. So now I'd like to go through a second concept. And several years ago, I was sitting in a meeting or in a workshop with a guy by the name of Todd Langford. So just, if you would, just write Todd, and then under Todd, write the word Langford. And below that, write Truth Concepts. Todd has spent most of his adult life, it's my understanding, building software to try to prove the truth about money. And in fact, one of the things that he will oftentimes say when people ask him a question about a financial action is he'll say, I don't know, let's just see how efficient that strategy is. And so really, this is where we got the name Efficiency of Money. I would credit this to Todd Langford with Truth Concepts. So while attending a workshop in Houston, Texas several years ago, he began the day making these comments. He said, first of all, he went to a whiteboard and said, there in the room, and he said, suppose you save $100. So do me a favor and write the word save, and below that write the number $100. He said, suppose you go to a bank, you save $100 in that bank, and the bank pays you 1% interest. His question then was, how much money is that bank depositor going to earn? And of course, those of us in the room said that's $1. Now, he then asked the question, and I'll ask you guys, what does the bank then do with the $100? How does the bank make money on that $100? Yeah, they're going to loan it out. So he then over here wrote the word loan. And he asked the question, he said, suppose the bank loans that $100 out to someone else and they charge 4% interest. So if you write that, $100 at 4%, then he asked the question, what's the bank making? The answer is $4. So next he asks the question, he says, if the bank is crediting or paying 1% interest to that depositor on that $100, and if they're charging 4% interest to the borrower on the $100, what is the bank making on their money? What percent is the bank making on their money? Well, I, for one, in the room I said 3%, and to the best of my knowledge, everyone around me echoed the same answer. And then Todd asked the question or made the comment. He said that would be true, except, again, the question was, how much money or what percent is the bank making on their money? And he pointed out that that $100 is not the bank's money. He said the only money the bank has in this transaction is the $1. He was writing with a black marker just like I am right now, and he said, if any of you in this room went into business where you could buy a marker for $1 and you could sell it for $4, what would you make on the transaction? Of course, it would be $3. Well, $3 on $1, that is a 300% return. So if you would, just cross through 3% and write 300%. Well, he didn't say this in the actual meeting, but we took it a step further because interest rates in this current environment are less than 1% with most bank savings. In fact, it's not difficult to find a savings account that pays 0.1%. Well, if a savings account pays 0.1%, you don't make $1, you make 1/10 of $1, which would be what? Be a dime, right? So if you write the word dime. Now, if the bank is still charging 4% on the money and they're earning $4, the next question is how many dimes are there in $4? Of course, that's 40. So in this transaction, if I could buy a marker for a dime and sell it for 40 dimes, I would then make 39 dimes, which would be 3,900%. So the purpose of this little thinking exercise, this part, is just to realize that saving and borrowing money from a bank is probably better for the bank than it is for the bank customer. And then that led us to the question, is there an alternative place to save and borrow money rather than just doing it at a bank? Is there another place to do it? And from the Nelson Nash book, Becoming Your Own Banker, we know that there is a place, a better place, and that is with specially designed life insurance contracts with a different type of financial institution, that being a mutual life insurance company as opposed to a bank. Okay, so now let's go to a third point, a third mathematical truth. So I'd like for you to, of course, write the number 3, and then I would like for you to write the first name Doug, and below that write Andrews, and below that write misfortune. That's a book that he wrote a number of years ago. So several years ago, I'm listening to a tape of Doug Andrews. He's doing a workshop with real estate agents and bank loan officers. And at the beginning of his conversation with this group, he made the comment that, we receive a 0% rate of return on the equity in the walls of our home. So if you'd write 0% rate of return and equity, and when he said that, and again, I was just listening to a tape of him doing this workshop, I thought that doesn't seem right. So, I don't know, a day or two later, I just kind of thought through it. And the way I thought through it, and I'd like for you to join me now, is I just drew a couple rectangles. And these rectangles represent houses. They represent properties. And I asked myself, if someone in my hometown on Main Street, if there was a house, if there were 2 lots next to each other, and the lots were exactly the same dimension, and a builder built a home on each lot, and the floor plan of the homes are exactly the same. So if the same builder, same floor plans, same dimensions of the lot, everything's exactly the same, and in this community, the houses would have to be valued the same. If one house was in one community and another house was 100 miles away in another type of community, maybe they'd be different. But next door to each other, they got to be the same. So that's the first assumption I'm making. And then I just said, suppose those houses, to use nice round numbers, suppose those houses were each valued at $100,000, okay? Now, suppose someone in this audience, suppose one of you decided that you were going to buy this home, and suppose that I decided I was going to buy the other one. Another assumption, let's say that you had $100,000 sitting in a cash account somewhere, and suppose I had $100,000 sitting in an account somewhere. Now, suppose that I buy my house and I decide I'm going to think in a conventional manner. I'm going to do what I feel like Dave Ramsey or Susie Orman or other financial entertainers would ask me to do. And they'd say, hey, if you got the money there and you can pay cash for it, that's what you should do. So I pay cash for my house. Now, if I paid cash for my house, then how much equity, I pay $100,000 for a $100,000 value home, how much equity would I have in my home if I'd paid cash for it? The answer would be what? Be $100,000. So if you would, write $100,000 equity in that rectangle, or representing that house over here. Now, let's suppose that you are able to think differently, and you decide that you want to maintain control of your money, and you feel like that what I did, what Mark did, is he gave up control to the bank. So the bank is now in control of my $100,000, right? The only way I can get that money back out is I'd have to go back to the bank and go through a process to access any of that money. But you, on the other hand, decide you're going to think differently, and you're going to go finance the loan, a loan on the house. And let's just say, for our purposes here, let's say that you find a bank that will finance the entire $100,000. So you do that. So how much equity do you have in your home? It'd be zero. So please write zero equity in this home. Okay. So you maintain control of your 100,000, and we have a thought that people who have opportunity will find people who have access to their money. Debt finds people who do not have access to their money. So you've decided to think differently, and you want to have zero equity in your home. So when I went through this thinking process, I then asked myself, I said, suppose a year goes by and the market in this community is good, and you find out that the house would appraise at $105,000. So if you'd write $105,000 up here, both homeowners figure out that their houses have appreciated by $5,000. So then I thought to myself, okay, it seems like that I made $5,000 on that $100,000, right? But then it seems like you made $5,000 on zero, on no equity. Well, that kind of helped me understand this simple fact that the only way that we get more equity in real estate property is we can pay towards the principal. If I paid $1,000 on the principal, I'd have $1,000 of equity, but I wouldn't have any more than $1,000. So I don't really make anything on my principal when I pay it. The $5,000 that we both got, the takeaway is that when a house appreciates, it appreciates whether there's a loan or not. Okay? So that was kind of a big takeaway for me, and that convinced me that Doug Andrew was accurate with that statement. Now, there is one more factor to consider, and that is that because you financed $100,000, you do have a cost. And the cost in this example, if we say, the interest rate is 4%, which is about what rates are today, 4% of $100,000 is $4,000. So if you guys earn exactly $4,000 wherever your money is residing, then you'll be even with me, right? But again, you'll have control of your money, and I won't have control of my money, okay? Now, if you earn more than $4,000, you're ahead. If you earn less, you're behind, but you still control the money. And again, we feel like that opportunities will find people who have access to money, and debt finds people who do not. Now we're going to go to the fourth and final point. And so if you'd write the number 4, and then I want you to leave a line. So I want you to go down to the second line, and I want you to write this mortgage, this amortization. Let's say someone takes out a loan for $200,200, and there's a reason I'm picking these numbers. And let's say the interest rate is 4.375%, and let's say it's a 30-year fixed loan. Well, the reason we selected those numbers is that makes that mortgage payment really close to $1,000 a month. If this is a 30-year fixed rate mortgage, what will this homeowner, if they pay $1,000 in the first month of the first year, what will they pay in the first month of the second year? What will the mortgage payment be? Okay, it'd be $1,000. What will they pay 10 years later? $1,000. What will they pay 30 years later? The 12th month of the 30th year? $1,000. So if you would, just write 30 years, $1,000. Let's suppose this homeowner, in the first month that they lived in the home, they happened to go to a local Walmart, and this little drawing represents a shopping cart at Walmart. And let's suppose they go buy the types of stuff that we all buy on a regular basis. And suppose, ironically enough, that when they go through the checkout, they spend exactly $1,000. Now, I just asked the question, 30 years from now, when this homeowner writes a check for $1,000, which is the same payment that they made 30 years earlier, if this homeowner 30 years from now goes to a Walmart and buys the same products, this is 30 years later, they're going to buy the same exact products that we buy every day. What will they pay for those products in comparison to 30 years earlier? Will it be more? Will it be the same? Will it be less? What will it be? They'll pay a lot more. Why? Because of inflation. So if you'd write the word inflation there, somewhere there in the middle. Now, who causes inflation? Correct. If you had a chance to listen, or still would listen to Nelson Nash or Carlos Lara, Robert Murphy, who wrote How Privatized Banking Really Works, Austrian economists, they would tell you that the banks and the government are able to work together to cause inflation. And they would explain what 10% fractional reserve banking means. And basically what that means is that if one of you in this room decided to go, if you made a deposit for $10,000 in a local bank, well, because of 10% fractional reserve banking, that bank would have to take $1,000 of that $10,000 and they would have to put it in reserve. That would enable them to then loan out $9,000 of the $10,000. So let's suppose Aaron, who's sitting in the room right now, deposited $10,000 in his bank. And then Mike, who's sitting in the room, you go to Aaron's bank the next day and you borrow $9,000. Maybe you're borrowing 9 of the 10 that he deposited the day before. So Mike then takes the $9,000. I'm just going to keep this straight in my mind. Aaron and Mike. Mike deposits $9,000 in his bank. So what does his bank have to do? Because of 10% fractional, correct, because of 10% fractional reserve banking, Mike has to, or the bank, Mike's bank has to put $900 in reserve, and then they can borrow, or loan out $8,100. Suppose I go into Mike's bank, and I happen to want to borrow $8,100, and I take the $8,100 and I deposit it in my bank, okay? And then my bank has to do the same thing. So very quickly, it would be possible that the $10,000 that Aaron dropped off one day can turn into 9 more and 8 plus more. So there can be 27,000 plus sitting in the money supply in a very short period of time. And that last 17 just kind of happened out of thin air. In fact, if you run this out the full course, banks have the ability to turn $10,000 into 10 times 10,000, which would be 100,000. That then puts more money in the money supply, which makes Aaron's original $10,000 worth less. And that's a way to understand inflation. So if we go back to this, as you said, because of inflation and because of 10%, which is caused by 10% fractional reserve banking, going to Walmart 30 years later is likely going to cost a lot more. So if you now jot this down, let's say inflation averages 3% over a 30-year period. Then 30 years later, we would know that the $1,000, if it's now being spent 30 years later, it will buy $411 of what it would have bought 30 years earlier. So this homeowner in the last month of the 30th year gets to write a check for $1,000 for their mortgage, but they'd have to write a check for probably 2.5 times or 3 times that amount to buy those same products. The importance of just going through this little mental exercise is that tells us that up here, these dollars in the beginning are worth 100 cents. Down here, these dollars are worth 41 cents. Well, a financial institution would rather have more 100-cent dollars and fewer 41-cent dollars. So one way this can work for a bank is they can simply say, why don't we give you a lower interest rate? Let's say we give you a 3.5% interest rate. And the misunderstanding is, for some of us, is that interest rates are the most important thing. But they're really not. Cash flow, I think if we think about it, is the most important item. So somebody does a 3.5% mortgage, but then you wouldn't be able to get that in this environment unless you shorten the term. So if you shorten the term to 15 years and you're still borrowing the same $200,200, the payment now goes to $1,441 a month. So what happens very simply is that you're now being asked to send an additional $441 into an asset that is making 0%. And then the bank is going to receive more 100-cent dollars, which is what they're looking for, and you're going to give up more control of your money to the bank. So to review, point number 1 is just to help all of us realize the concept of an opportunity loss. point number 2 is to understand, or really just to ask the question, is there an alternative place to save money, save and borrow money to the banks? Point number 3 is that we receive a 0% rate of return on the equity in our home. And point number 4 is that a more cash flow efficient bank loan, like a 30-year loan, which is more cash flow efficient than a 15-year loan, but it's also a great counter to inflation.